To keep yourself updated, subscribe to IndigoLearn and click the bell icon and download our app OneFin to start learning on the go.
So now to understand the disclosure requirements and how the intangible assets are presented and what are some kind of disclosures what entities make, let us look at few annual reports. This is the one from Z Limited. This is the balance sheet as of 31st of March of 21, right? So if you see under the non-current assets, you have goodwill, you have other intangible assets. There is a separate schedule for this. We'll visit the schedule. And there are certain intangible assets under development, right? So these are basically not yet completed, they are under development. Now what does Z Limited do? Z Limited is in the media business, right? Now they create a lot of content. What kind of content? They create, movies, maybe they create web series, they create serials, right? They have their own app, all of those things are there. They're creating intangible assets, right? So let us see what kind of disclosures do they make. Now why am I taking Z Limited example here? Because here you would be able to see the relevance of intangible assets. And not only this, I suggest you to have a look at any other company where you see there can be an intangible asset. Maybe the company has an app. Let us say you look at Swiggy, you look at Zomato, or there is a company which creates series and all. You can have a look at Netflix, right? I'll also take you through Amazon's report, because it's important for you to understand the context. And let me tell you, as technology improves, as the usage of technology keeps on increasing, where you have a lot of things around this, intellectual property rights and all, intangible asset is going to be one of the most valuable asset to any entity. During industrial area, tangible assets were important. Where do you set up the factory? How big is the factory? All of those were important. In this era, you will see intangible assets gaining significant importance, right? So it's important for you to understand the relevance. It's not that you just learn the definition, you write in the exams and you pass. No, it doesn't work that way, right? So let's go to note number 7. So let's go to the notes forming part of the financial statements on intangible assets. What do they say? Intangible assets with finite useful lives that are acquired are carried at cost less accumulated amortization and accumulated impairment losses. So this is the accounting policy. They are following the cost model. Amortization is recognized on a straight line basis over the estimated useful life. So they say we'll amortize it on the basis of straight line method over the estimated useful life. The next item says estimated useful life of intangible asset is 3 years. Now, how is that? Let's say they create a series or a serial. It has an estimated useful life of 3 years. Now, that is a management judgment. It may be possible some of the series may last longer for 3 years. Some of them may be lasting less than 3 years. But it's a management judgment that on an average, estimated useful life of an intangible asset is 3 years. And you would realize that as a web series gets older and older, the users who would be watching those web series would be fewer. So, most of the value comes in the first couple of years only, right? The estimated useful life and amortization method are reviewed at each accounting period with the effect of any changes in the estimated being accounted for on a prospective basis. This is as given by Ind AS 8. Then they talk about intangible assets acquired in a business combination. Intangible assets acquired in a business combination and recognized separately from goodwill are initially recognized at their fair value at the acquisition date, which is regarded as their cost. So, initially we will recognize at fair value and that will be the basis of cost for subsequent measurement. Subsequent to initial recognition, the intangible assets acquired in a business combination are reported at cost less accumulated amortization and accumulated impairment loss on the same basis as intangible assets that are acquired separately. So, whatever intangible assets you have acquired separately, for that also you are using the cost model, and for intangible assets that are acquired as a part of business combination, even that is being measured using cost model. Now you may be wondering, the note on intangible asset only spoke about intangible assets acquired separately and under business combination. Then what about intangible assets generated internally? Maybe they are treating it as inventory. So I am just taking you through the note on inventory just for you to correlate between what happens when an intangible item is an intangible asset and when it is treated as inventory. So if you look at inventory, they say inventory of media content. So remember, there is an exclusion from Ind AS 38 if it is covered by Ind AS 2. So this aspect is covered by Ind AS 2. Media content, that is programs, film rights, music rights completed, commissioned or acquired or under production, including content in digital form, are stated at lower of cost, unamortized cost or realizable value, right? So that is as per inventory, okay. Then they have given how do they expense program, film rights, music rights, etc., which are treated as inventory. Programs. So if it is a reality show, chat show, event, game shows, etc., they are fully expensed on telecast or upload. Now what does that mean? Assume there is KBC, Kaun Banega Crorepati. I know it is not produced by Z, but assume it is KBC. Now the date the episode is telecasted, on that day the expenses will be recognized in the P&L. Why? Because once an episode is released, then subsequently nobody will go back and watch those old episodes, right? They may repeat the telecast hundreds of times, but once it is telecast, then it is expensed. Programs other than one above, maybe serials or all of those things, are amortized over 3 financial years starting from the year of first telecast upload as per management estimate of future revenue potential. So if there is any other thing, for example, it is not a reality show and all of those things, they believe that they will get a benefit over a 3-year period, and it is amortized over a 3-year period. Then, film rights are amortized on a straight line basis over the license period or 60 months from the commencement of rights, whichever is shorter. Then, music rights are amortized over 3 financial years starting from the year of commencement of rights as per management estimate of revenue potential. Then, films produced or acquired for distribution sale of rights, cost is allocated to each right based on management estimate as below. Satellite rights, allocated cost of right is expensed immediately on sale. So if you have given a satellite right, immediately expense. Theatrical rights, 80% of allocated cost is amortized immediately on theatrical release, and balance is amortized equally in the following 6 months. So what is theatrical release? They are being released in theatres. Movies are being released in theatres. 80% of the cost is amortized immediately when there is a theatrical release, and balance is amortized over a period of 6 months. IPR, allocated cost of IPR are amortized over 1 to 5 years subsequent to year in which film is released, so depending on the category. And music and other rights, allocated cost of each right is expensed immediately on sale. So for different categories, they have different amortization basis. Right. So this covers some of the intangible items appearing in the balance sheet of a media company, right? We spoke about inventories and we also spoke about intangible assets. Then let's look at the notes forming part of the financial statements where they have given the details of goodwill and other intangible assets. So you have goodwill, trademark, customer list and websites. Now, if you remember, we had both the kind of discussion, right? Internally generated goodwill, customer list, if they cannot put a cost to it, if they are not able to measure the cost reliably, or if they are not able to control, then they cannot be recognized as intangible assets. But if you have acquired a customer list, then maybe it is possible to recognize the intangible asset. Or if they can reliably measure the cost of building this customer list, then that can be recognized as intangible asset. Okay. Then you have software and then you have channels. And they have given the details of 1st of April 19 as at 31st March of 20 as at 31st March of 21. So opening balance and the closing balances. Now they have given it for 3 years because I think the 30th March of 20 balance sheet is a restated one. That's why they have given 1 more year of disclosures. Then what is the accumulated amortization? What is the accumulated amortization, additions, disposals, then what are impairments? Those are given. Then the net book value or the carrying amount as at 31st March of 21 and as at 31st March of 20 is given. Now let us have a look at Amazon's financial statement and we will see how they have disclosed intangible assets in the financial statements. This is not as per Ind AS or IFRS, this is as per US GAAP, but still it will help us understand the kind of disclosures that are done, the kind of accounting policies that are chosen for intangible assets. So you can see digital video and music content. V means the company obtains video content inclusive of episode television and movies and what all they obtain, and music content for customers through licensing agreement that have wide range of licensing provisions including both fixed and variable payment schedules. So they get your maybe movies or music and all of that. Some of you would be watching, some of you who have Amazon Prime subscription, you would be watching them as well. When the license fee for a specific video or music title is determinable and reasonably estimable and the content is available to us, we recognize an asset and a corresponding liability. So here again, the cost being measured reliably, that aspect is included in this sentence, right? Then as you pay, you reduce the liability that is there. And we amortize the asset to cost of sales on an accelerated basis based on average usage or viewing patterns or on a straight line basis. Now here you can see either on a straight line basis or on viewing patterns. Now here viewing patterns is a reasonable estimate of the benefit that will flow to the entity. If the licensing fee is not determinable or reasonably estimable, no asset or real liability is recorded. So if the licensing fee is not determinable, then you don't recognize, and licensing costs are expensed as incurred. So if there is a variable payment, they are expensed as incurred. We also develop original video content for which production costs are capitalized and amortized to cost of sales predominantly on an accelerated basis, right? When you say accelerated, they use maybe WDV or accelerated WDV method. that follows the viewing patterns associated with the content. So initially you will have more viewing, and towards the end of the life you will have lesser viewing. The weighted average remaining life of our capitalized video content is 2.5 years. So they estimate that on a weighted average basis, so much of content available, right? On a weighted average basis, the remaining useful life is 2.5 years. Then they have also mentioned how they monetize their video content. Our produced and licensed video content is primarily monetized together as a unit referred to as a film group in each major geography where we offer Amazon Prime membership, right? So if you see, you can access the content using Amazon Prime membership, and that is valid for 1 year, right? Now that Amazon Prime membership refers to the revenue side. Amortization happens on an accelerated basis as explained in the paragraph above, right? So this is another thing I wanted to share it with you. Whenever you have free times, do look at financial statements of companies where you can get an insight of how they measure and present these intangible assets. Please remember, if you read a couple of annual reports, a lot of things that you have learnt in Ind AS, you will be able to remember and relate to, right? Sure. And now I am taking you through Tata Motors annual report where we are looking at the notes to accounts with respect to intangible assets, right? So here if you see, again similar to what we saw in Z Limited, intangible assets purchased including those acquired in business combination are measured at cost or fair value as of the date of acquisition where applicable. So basically the same principle, less accumulated amortization and accumulated impairment. Intangible assets with indefinite lives are reviewed annually to determine whether an indefinite life assessment continues to be supportable. If not, the change of the useful life assessment from the indefinite to finite is made on a prospective basis. So this also we have understood. For intangible assets with finite lives, amortization is provided on a straight line basis over the estimated useful life of the acquired intangible asset as per the estimated amortization period given below. Now they have given us for patents and technological know-how 2 to 12 years, computer software 1 to 8 years, customer related intangible, that is dealer network, 20 years, and intellectual property rights 3 to 10 years. So they have given us the useful life over which the intangible asset is amortized. Now the amortization period for intangible asset with finite useful life is reviewed at least each year and changes is accounted as changes in accounting estimates, nothing difference. Then coming to internally generated intangible asset, research costs are charged to the consolidated statement of profit and loss in the year in which they are incurred. So we are referring to consolidated P&L. Even in the standalone P&L, similar principle would be there. Product development cost incurred on a new vehicle platform, engines, transmissions and new products are recognized as intangible asset when feasibility has been established, the company has committed technical and financial resources to complete the development, and it is probable that asset will generate probable future economic benefits. So those 6 conditions, right? Now they have not mentioned about resources and all, but you can see that once they are committed, once they can prove that yes, they can start getting future economic benefits, they will capitalize the intangible asset. The costs capitalized include cost of material, direct labor, directly attributable overhead expenditure incurred up to the date the asset is available for use. Interest cost incurred is capitalized up to the date the asset is ready for its intended use based on borrowings incurred specifically for financing the asset or weighted average rate, right? Product development cost is amortized on a straight line basis over a period of 24 months to 120 months. Product development expenditure is measured at cost less accumulated amortization and accumulated impairment if any, right? So they have given specifically what they do when they are generating an intangible asset internally as well.